In this video, we will be discussing how to read the Commodity Futures Trading Commission's Commitment of Traders report. Stick around to the end to see how reading the COT report can transform and significantly improve your algorithmic and discretionary trading. This video is sponsored by Prosperity Algo and our free Golden Time Bomb Expert Advisor. Do you want to make 100+% annual returns through automating the London breakout and the opening range breakout? Then click the link in the description. So starting us off here, what is the COT report? And quite frankly, the Commitment of Traders report is a regulated report put out by the body which regulates all commodities trading activities in the United States, or the Commodities Futures Trading Commission. And what effectively is this report? Pretty much every week, the exchanges need to report the positions held by all traders in the futures markets. And this is really done to effectively protect the integrity of the market. Because us as traders often forget that futures they serve a real commercial purpose. If you're a farmer and you grow wheat, you want to be able to hedge your wheat production so that you have a bit more consistency in your cash flow. Or for us as gold traders or even various speculative investors, you would want to be able to hedge your mining, or you'd want to be able to potentially hedge your S&P ETF portfolio through the use of futures. And because of this, especially for in agricultural or more food-related contexts, the US government wants to make sure that nobody tries to corner the market in a particular future, and that's why they often have reporting. If you guys are commodity trading nerds like I am, I highly encourage you to read The World for Sale and also The King of Oil, which both document the story of Mark Rich and Glencore. And it's quite neat, actually. They almost cornered, I believe, the nickel market back in the day, or the aluminum. And they even sold all the wheat to the USSR back in the day, too. So all of these different things where effectively one market participant tries to take such a massive position in a particular market, be it spot or financial futures. The CFTC wants to make sure that this doesn't happen and that people are aware of it. Therefore, they have these enhanced reporting requirements. But what does that kind of practically mean for us as traders? What that means is that every Friday, the previous Tuesday's positioning of all traders is published in a public, open area that everybody can see. And specifically here, if you go to the CFTC's website under the Commitment of Traders and you kind of navigate over to the metals report, because this video will focus on gold, you can see that there's this beautiful report published in text format, which comes out every week. And that tells us essentially which different participants in the market are holding what. And really there's three major categories, which are then broken down into smaller categories. There's the producers or merchant users category. There's then more the managed money and the large speculators category. And then there's the retail traders, which are the non-reportable positions, which is effectively the delta solving for all contracts on the market. So what they will do is they're effectively looking at all long and short positions held in a current futures market. So here we're looking at gold futures, and then they would then break it down into who's holding long, who's holding short across those three categories. And the total positions ultimately need to sum up to zero, right? Because if one participant in a true exchange traded market is short, somebody else has to be long because it's a two-sided contract. But this essentially enables us to see where different participants are positioned in a market. So you're able to see like, hey, what are the big hedge funds doing this week? Are they long gold? Are they short gold? And at the same time, you can see what are the big miners doing? Are the miners long gold? Are they short gold? And what is the positioning there? And another thing that people like to do is what are the retail traders doing? Retail traders are generally wrong in terms of market direction. So if you some people like to just take the opposite direction of the retail traders, because if they're wrong 90% of the time and you take the opposite direction, in theory, you should have a bit of an edge there. So there's different ways of looking at the exact report, but really it gives us a pretty tremendous edge. And effectively, people sometimes have different views, like, oh, we should just do exactly what the producers are doing, or we should do exactly what the money managers are doing. And there's different theories behind that, such as like the miners should know more about the price of gold, or especially if you look at agricultural or soft commodities, like a farmer probably knows what's going to happen to the wheat market because he has a pretty good inclination of like how rainy it's been, how crop yields are going to be. So he almost has insider information. So it could be good to kind of ride his coattails. However, kind of the caveat to that is most producers will use futures not necessarily purely as a speculative investment, but more so to hedge their production. So even if things were going well, they might very well take short positions just because they want to hedge just in case something happens. It's more of an insurance process, whereas speculators are almost exclusively buying to make money off of financial speculation. So you kind of need to be a bit more nuanced, and it isn't as simple as, oh, the smart money is doing this, or the retail is doing that, and we should either go with them or against them. You need to be a little bit more nuanced about that. So here, let's kind of now actually break into a nice chart here from Bar Chart, which shows the net positioning. And here you can look at both the aggregated and the disaggregated report. And the disaggregated report corresponds to this one, where they pretty much just break it down into more subcategories. So here they just do commercials, large speculators, and retail, and here they just further break it down. But what this is really interesting is it shows you how a certain participant group is positioned long or short relative to historic times. So you can see that this week, for instance, managed money is quite long gold relative to the past previous times. So this likely means that at least the overall aggregate of hedge funds and money managers believe that gold is in a bullish market. However, here we can also see that, for instance, producers are at an all-time net short. So that could mean that perhaps some producers, either they have a bullish bias or a bearish bias, or more likely, they view that this is a very good time to kind of lock in some profits on gold because gold is quite high, and they want to make sure that they capitalize on that, and they effectively are pre-selling gold at the current market price because they feel that, hey, it's a good time to kind of lock in a long-term price. But essentially, charts like this, and there's quite a few free ones online, can give you an idea of what the market is doing. And why this is important for you, even as an algo trader, is it can help you set a weekly bias. So you're probably not going to day trade based on the Commitment of Traders report. It's not going to tell you to like essentially take a scalping position on the 930 bar of the New York session. However, it can help you determine a weekly bias, and this can help you determine which bots or which strategies are best for that week. So for instance, gold currently, we're hitting all-time highs after all-time highs, and it's absolutely flying. Let me just grab up a nice chart here for us. Yeah, you can see on the 4-hour, like gold, we're hitting higher highs, and largely due to the tariff concerns which have been happening this past week. So had you read data sources like the COT report, as well as other fundamental news drivers, you may have known in advance that this might be very well an exceptionally bullish week, an exceptionally trending week. And that could have then gone to inform what type of portfolio strategies you want to run. So for instance, breakout strategies have been performing exceptionally well this week, whereas more mean averting strategies on gold and other risk off assets have not been performing as well. So that's really why, as a algo trader, you should still be mindful of what's happening here. So now let me just kind of show you guys one more thing, which I think is really interesting, is that all of the COT data is actually downloadable. So like you could actually download the historic data. And there are services which you have to pay for to do this, or you can simply go to the CFTC's website and export a bunch of CSV files. And the really cool thing is that you're able to essentially see this report as far back as, I think, several decades. I grabbed it up from 2020. And the interesting thing here is that I find with fundamentals, the most helpful thing you can do is still try to quantify them. So a lot of people, especially discretionary traders, will say, oh, I think a lot of managed money is going long this week. Perhaps that means it's going to be bullish. But you need to be able to actually benchmark it against what is a relative long position, like what is a historically long position, almost turn it into an indicator itself. And that's why being able to just effectively play with the data here can be quite helpful. So not to go too much into the weeds of what I've been doing here, But something that, for instance, I've been working on recently is looking at different groups and if they give you an edge in regards to predicting the price of gold for the next week. So effectively, you can see like if week over week a particular type of participant either increase their long position or increase their short position, what happened to the price of gold the next week. And you can see that the edges here are relatively small, but effectively by taking this data and turning it into a binary classifier, so like if a certain group increased position, that's 1, if they decrease position, that's -1, and then what happened the preceding week to the price of gold. So effectively trying to see if a certain group has predictive power into what's going to happen to the general direction of gold the next week. And then something else which I found really interesting is essentially looking at how net long or short a particular participant group is. That's as simple as taking their net positioning, which is adding up the longs and the shorts, and dividing it over the total contracts held by that group. In this case, this was the large speculators, so hedge funds, money managers, etc., and then looking at like what percentage are long or short are they, as well as are they increasing or decreasing week over week. So here you can see in like March of this year, a lot of participants were just significantly increasing their long positions. They were piling into longs into the market. And then, yeah, it just gave us a fairly interesting approach there. And then effectively what this analysis allowed me to do is start to quantify some of the what people say about the COT report. There are certain traders that feel that if too many large speculators are bullish, that means that the markets might reverse. And some people say that if they are super bearish, the markets might ultimately become bullish because of more of an inverse or a supply and demand imbalance in the markets. But what this analysis allowed me to do is essentially say that depending on how bullish and or how bullish the actual large speculators are, what is the probability of the market going up, the gold market going up the next week? And specifically what I did here is in this little pivot table, you can effectively see that when large speculators are relatively neutral, so they have a bullish bias, and they always have a bullish bias because most CTAs are trend following, the markets don't really have much of a predictive edge. So if they're bullish like business as usual, they don't really have a super good predictive edge. However, if large speculators are either extremely bullish or extremely bearish, gold historically went up. So that means that either if everybody thinks the world is going to collapse, that means that likely there's a supply and demand imbalance and gold futures might rise going forward. Or alternatively, if everybody's just piling in, they're incredibly bullish, perhaps something like a fundamental driver like this week, the tariffs are happening in the market, which is more likely to cause further bullish price action in the coming weeks. So essentially, this is a bit too in the weeds to get into in just a short video, but effectively it shows that you can download this data, you can look for relationships in the data, be it by transforming it into binary outcomes or looking at more like probabilistic distributions, and that enables you to essentially try and make sense of all of this noise. But the reason why I'm trying to do this is effectively because if you're able to predict if a market will be bullish, one of the best ways to make money is just going long the index with leverage. So if you ever look at levered ETFs, for instance, like the TQQQ, you can see that like the returns in a bull market are astronomical if you just essentially buy a leverage or buy an index with leverage. In the case of CFDs, you can simply buy when market opens and sell when market closes. However, obviously, if you enter a bearish market and you try to do this, you're going to lose all the money because this is not a bi-directional market strategy. So essentially what I'm trying to determine, what I'm trying to build an expert advisor around, is if you can effectively crunch fundamentals data to get an idea of the market's like overall weekly trend. And then if the trend is likely to be bullish, you can effectively just enter a buy and hold position like a swing trading approach with leverage. So that's what I'm working on. But guys, hope this video was helpful and hope that you now know how to go to the COT report, essentially look at it. Highly recommend Googling bar chart as well if you want to get access to this chart, and let me know in the comments if you have any questions. Take care.